The ringgit has been in decline
The
for the last
ringgit
10
came under
years.
pressure last week.
Malaysia memang jatuh, habis mesti naik lah barang.
The recent depreciation of the Malaysian ringgit has sparked many concerns and many discussions among the Malaysians. Some attribute this trend to the increased interest rate in the US and the sluggish Chinese economy. But we do not just start complaining about our ringgit recently, right? We have been complaining for who knows how long. So it should be a structural problem instead of a cyclical one. Hence, the explanation above has actually offered a little understanding about our ringgit's weakness. To make it simple, Malaysia is simply stuck in the middle income trap, a condition where we should not have compared Malaysian ringgit to the Singapore dollar, and we should in fact accept the fact that Singapore dollar will always be more valuable than ours under current economic structure. Just imagine a restaurant serving both chicken and steak dishes. Do you think they'll be priced similarly? But who then should we or should Malaysian ringgit be compared to? Indonesia, Thailand or Vietnam? We do share a similar economic structure where we do a lot of manufacturing and export them. But are Malaysians comparing our ringgit to theirs? I do not think so. We have higher gross national income per capita, which means we possess higher purchasing power, which means we spend more, which means we are more likely to feel the pinch of a weak ringgit. That's why we run so much. We want to go up a higher tier. In short, to do that, Malaysia needs a firm structural reform. Before we start, it's important to know that Malaysia adopts a floating exchange rate regime, where the value of the Malaysian ringgit is determined by the market demand and supply. Simply put, when more people want Malaysian ringgit, its value strengthens and vice versa. And the demand for the Malaysian ringgit comes mainly from these two sources: exports and foreign investment. Let's first explore exports. People are always saying Malaysia has done a great job in terms of exports and the overall economic health, right? But why we as citizens can't see the greatness of our economy? And I ask a similar question as well. If our exports are so strong, where more countries are demanding Malaysian ringgit to purchase our goods, why isn't Malaysian ringgit strengthening or at least not dropping? After going through all the reports and numbers, I reckon there are two primary factors behind the weakness of Malaysian ringgit. First, low value added exports, and second, weak portfolio investment. Look at the diagram and we can see Malaysia's main export is electrical and electronic products, and the rest of them are mainly commodities. Here lies the problem. Commodities are first, not highly valued products. Second, they are extremely volatile in their prices. The changes in value of these products are huge and has no predictable pattern which can be seen from the number in the red box. This leads to the instability in the demand for Malaysian ringgit, which translates into unstable currency valuation. How then do we expect foreign investors to have confidence to hold or invest in our currency? What about our electrical and electronics products then? It has its own problem as well. Compare Malaysia's high-tech exports to others. Even though high-tech exports account for over 50% of manufactured exports, the value is still so far lagging behind those of Korea, Taiwan, and even Singapore. Have a look at this diagram as well, and you can see the sales value of our export-oriented industries as dropping consistently. It now points to the fact that Malaysia produces low value added exports, which hinders Malaysia's pricing ability over exports, resulting in a relatively lower amount of MYR needed for foreigners to purchase, in contrast to countries that are able to sell their high value added goods at a higher price. Do not forget we do import as well, and look at the graph. There's such a small gap between export and import value, which means the net demand for Malaysian ringgit is low, and it explains why Malaysia seems to export a lot and there is never an uptrending force on our currency. the demand for Malaysian ringgit is very much offset by the payment we made on imports. To put it into context, look at the net trade in goods of all these countries. Now, let's look at Malaysian foreign investment. Recently, the efforts of our Prime Minister in securing multiple FDI from trading partners have been incredible. Despite the bright performance from FDI, foreign investment have been struggling for almost a decade. Foreign investment, unlike FDI, is more closely linked to financial markets, encompassing stocks and bonds. Look at the similar trend depicted by both the Malaysian stock market and the ringgit performance. That experienced the same significant drop in 2014-15 and 2018. The weakness in our financial market is mirrored in the sluggish performance of the ringgit over the years. It brings a message where Malaysian companies and economies are not attracting enough foreign capitals into their businesses. What is the difference between FDI and portfolio investment then? And why does FDI seem to not strengthen the Malaysian ringgit? First, FDI does not create a one-time huge demand for the ringgit. Instead, it's often carried out in multiple small stages. It means the impact on the Malaysian ringgit happens smoother, not resulting in a sudden strengthening of the currency. Besides, FDI is much more expensive than portfolio investment to service due to the ownership structure. Foreign investment are usually serviced in the forms of dividends, rents, interest, and profits, recording an income outflow. There are two scenarios here. Let's imagine the first one. John, an Australian, invests in Malaysia due to our business-friendly environment. He set up his own restaurant business here. He runs and controls the whole business, hence he holds a major ownership stakes. After the restaurant has made some profits, he's very likely to take it back to his home country. Second scenario, Alex, he's also an Australian, stumbled across a great restaurant chain in Malaysia and invested in it. In this case, he didn't set up his own restaurant in Malaysia. He doesn't run and control the business. He only holds minor ownership stakes. After the restaurant has made some profits, he would demand for some return for his investment from the restaurant. However, it's up to the restaurant board of directors to decide on how much to keep for the business development and for the investors. In short, FDI incurs higher costs for a nation to serve, and both forms of investment serve different fundamental objectives. FDI could potentially burden Malaysia with high servicing costs due to the ownership structure. To put this into context, we look at the primary income that records the income flows of a nation. Look at the graph. Malaysia has been paying more and more to the foreigners, supplying a higher amount of the ringgit to the foreign exchange market each year. And guess what? Direct investment is the one that accounts for the largest share of the outflows. Next, foreign workers. Malaysia is undoubtedly over-reliant on foreign workers. They are another major supplier of the ringgit. Evident by the data, they often send a portion back of their income back to their home countries which require remittance. In fact, Malaysia has surpassed both Thailand and Indonesia in terms of the highest amount of personal remittances paid out. This serves as an additional source of supply that further exacerbates the ringgit weakness. Lastly, Malaysia is a net service importer, which means we pay more than we receive. This doesn't mean Malaysia does not have a strong service sector. In fact, this sector contributed over 900 billion ringgit to the Malaysian GDP with a steady growth rate. It's the greatest contributor to our national output, but not internationally. This issue underscores Malaysia's ongoing struggle with low value-added exports. Being a net service importer, it worsens the ringgit value given that our trade surplus is really not big enough to offset the service payment we made, and of course, can't be counted on to strengthen the ringgit. The weakness of the ringgit requires a clear direction and structural reforms from the government. It's not a short-term discussion. We as citizens must voice constructive criticisms and let the government be willing to take the public opinion. Mere scolding and ranting make no contributions to the ringgit's strength. Structural reforms need years to be planned and carried out. Short-term wise, let's hope that those big banks and institutions stop placing their money in the US and bring Malaysia at least back to below $4.5. Long-term wise, let's hope the ringgit will be on par with the Singapore dollar. The government has to do their job and we must be patient as well. but at the same time play the role of supervision.